Ellianna. How are you going?
Good, thanks. How are you?
Good. Obviously been big moves in markets, as usual, it seems.
What's been going on the last couple of weeks, especially with the US?
Yeah, obviously there was some big moves. There was that initial moment where it was leaked that the tariffs would only be 10% and markets rallied. I think that would have been a relief. Like, when you think about tariffs, like in most countries, if you have a 10% tariff, especially with the United States or a major trading partner, the currency will just adjust. The currency will drop 10% and it's more or less business as usual. Like a 10% tariff probably slightly weights things, slightly incentivizes more manufacturing and business in the United States, but isn't returning the global order or anything. And then what came out were these huge tariffs. I think with a couple of rounds with China, it got to 125%. I mean, that's not slightly adjusting the balance of trade. That's like potentially, destroying every company that relies on that trade and reorganizing the whole system. So I think that sent a pretty strong message. The question I think you have to answer is what's the United States actually trying to do? And will they blink if the markets, continue to sell off? And we did kind of get answers to that. So if Trump is just trying to rebalance trade a little bit and it's a negotiating ploy to get better trade deals, that is unlikely to affect markets significantly. If, on the other hand, he's serious about moving manufacturing to the United States, then that is a big deal. My read is that basically that's what he wants to do. He's been talking about it, his whole life, and he seems to be very serious about getting that manufacturing to the United States. And whether he does it, this round or it happens slowly over time, I'm not sure. But I'm increasingly sure that the success of his policy will be how many of those factories actually move back. I think the thinking there is also that there's a lot more automation now. Actually, there's a few reasons. There's like the defense reason. They actually want to bring manufacturing to the United States so they can win any war that depended on like large amounts of material, specifically drones.
Do you think that the tariffs will be effective in bringing manufacturing back within Trump's presidency, or do you see that being a much longer term plan?
Yeah, well, that's the thing. I mean, you can't do this stuff overnight, right? Especially big companies. They often invest on 10 or 15-year time horizons. If you need to build a plant, you need to model out the lifetime value of everything that comes out of that and the return. So it seems like they want to get the pain done early. So if things are difficult now, but by the end of his presidency, there's a manufacturing renaissance in the United States, that's a huge success. And it seems like they are willing to go through a lot of short-term pain now. If they're going to be openly hostile to trading partners, even allies, then at the margin, people will eventually invest more in the United States. It's pretty clear now if you have US manufacturing, you're less at risk. But the real problem is that it's creating a huge amount of uncertainty because the amount of tariffs, what they apply to, it's all changing by tweet almost by every day. There was a huge market sell-off because these tariffs were so big. And there was this assumption that was going to gummy up global trade and global GDP and would almost certainly cause a recession. Markets collapsed. And then he largely, not quite reversed it, but, stepped back in a big way. He said that most tariffs were going to be paused for 90 days. And then just over the weekend, he said that smartphones were going to be excluded, semiconductors were going to be excluded, though again, there's uncertainty over that. It's really hard because if you're making decisions around where you're going to invest, the only real rational thing is just to wait and see where everything lands. And the problem is, if everyone's pausing their investment and waiting to see where everything lands, that's like textbook recession. They're generally caused by everybody just cutting back on investment and delaying investment plans. That kind of causes a negative feedback loop. So it's not clear yet how that will play out. But there's a lot of risk. You're really playing with fire here. Trump wouldn't be the first person that, kind of was humbled by the world. It's almost like a classic hubris thing. Like, how much power can you actually have? Will he be able to even push through if there is a global recession? One thing I did notice, which was encouraging, was when he walked back the tariffs and markets rallied, everybody in the administration seemed extremely happy about it. So when markets were selling off, they're all tweeting and talking and saying this isn't a big deal. It's short-term pain, long-term gain. Where we've got a long-term vision here. But as soon as market rallied, they seemed delighted. So I think that there is a feedback loop. And, it reminds me a bit of 2022, where they were raising interest rates to combat inflation. And every time the market rallied, that was almost seen as, oh, we've got more space to go up. We're used to having a put in the market where when markets sell off beyond a certain level, policymakers respond. But sometimes there's these dynamics where if markets rally, policymakers respond in the opposite direction. So if there was a significant rally, from here, I imagine Trump would see the tariffs as a success and would probably push forward further. But all this is kind of a wash. If his real intention is to bring manufacturing back to the United States and he sees tariffs as the main tool, yeah, there's a huge amount of risk.
Absolutely. And how are you managing risk at this time, especially compared to we just mentioned about 2022? What's your approach right now?
Yeah, I think there's basically big parts of our portfolio. One is healthcare and biotech, and the other is US tech and growth. It is not necessarily just the United States, but the vast majority of fast-growing companies are listed in the United States. Our risk models took us out of those positions quite early on. You took a bit of a hit in the first week of March, or from the first week of the sell-off from the peak in February, and then we were basically 40 to 50% cash throughout. The problem was we decided our biotech positions would hold, partly because they're pretty illiquid, and also because they're quite jumpy. I mean, if you've got a data readout coming out, they don't tend to trend in the same way. It's much harder to use those kinds of risk models. And the last thing you want to be doing as well is like hosing a small company to oblivion. But then basically it turned out sector-wise, healthcare came under a huge amount of pressure in Australia and in the United States for different reasons. So in the United States, research institutions are under a lot of pressure. Grants are being cut, department funding is being cut. Universities, which often run trials and, provide a huge amount of support to research. It looks like their funding is a lot less secure now than it was before. But also on the bigger end of town, on pharmaceutical companies, it's not clear. They're under a ton of pressure as well. They're under regulatory pressure in terms of pricing. They're also under pressure in the sense that nobody's really sure how this affects the FDA. There were a huge amount of job cuts in the FDA, some of which were walked back. But everyone was kind of concerned that this would delay trials. Would it affect people's plans? It's just, again, it's kind of like the global economy. There's this uncertainty, which makes it really hard. And so it's sent a lot of those companies into a bit of a tailspin as well. That feeds through to the biotech sector because everybody's relying on pharmaceutical companies ultimately to take their drugs to market. Most companies want to fund their trials, and then once it's successful, the most value creative option is generally to sell it to somebody who already has distribution in place and can very quickly roll out whatever drug it is to market. And so US biotech got smashed. And in Australia, we had another whammy. So in Australia, companies are also dependent on the FDA because that's the biggest market. They're also generally dependent on offshore companies as an exit strategy. So the appetite for big transactions offshore directly translates into the exit outcomes for Australian companies. But also we had the Opthea collapse where, it was nearly $1 billion, or was over $1 billion company at one point, which basically got zeroed. And that's definitely impacted risk appetite for retail shareholders, and also a number of institutions were invested in that. Seems like everybody's kind of certainly re-examining every biotech position they have with fresh eyes. It's a real reminder of the risk in the sector, and that pushed things down a lot. To answer your question about how we're managing risk, one part of the portfolio actually did fine. US tech and growth was mostly in cash. We sold almost all of those, and subsequently a lot of those companies end up dropping 50% or more afterwards. At the biotech sector, we basically took that on the chin, and that's been quite painful. But I think in terms of how it plays out, I mean, in 2022, something like 40 or 50% of companies traded below cash. That number's now about 25% after the recent sell-off. So we're getting close to those extreme values. Now, what happened was companies that didn't really deliver or couldn't progress or couldn't secure funding because their results, their data wasn't top tier, they generally stayed down. They didn't necessarily recover strongly. But the companies that did succeed, they had positive trials, they didn't just go up by 2 or 3 times. We saw companies go up, tenfold, in days on success. And it's basically what's happening in Australia too. So we have a number of companies now where they're taking a huge hit, but the data is still good. And if that data continues as it is, the upside isn't 2 or 3x from here. We're back to 5 to 10x or more. And so that's kind of exciting now. Pretty much everything we own does have quite convincing data. Most of what we own is extremely convincing, actually, market-leading data. And so it's almost like a matter of time. In these periods, it happened in 2022 as well, where anything that was kind of more than a year out, people sold and got smashed. So if you think about what a professional manager's doing now, they're going through every position. They're thinking, okay, if we go into a recession, if the sell-off continues, what are we actually going to own through the sell-off? And which ones are we going to sell and potentially take a look at again at a later date? So everyone's running the ruler across their portfolio. And generally what they'll do is anything that's, 2 or 3 year play is the first to go when you go through one of those periods. But again, time does pass. So in 2 or 3 years' time, these companies will have delivered their results and they will be sitting in a very different position. So the risk is kind of manifested and the reward is much higher than it was before.
Absolutely. So it sounds like there could be some positivity in the long term for healthcare in Australia.
Yeah, definitely. I mean, if you get something right now, the upside is enormous.
What are you looking at in US companies, primarily in tech and consumer, when you're going to consider buying back in, whatever that may be?
Yes, we just started buying basically this week. both in Australia and the United States. So, there's Hims and Hers, which is a leading telehealth company that's massively taking market share in a very fast growing sector. You bought back into that, that sold off from 70 to 25. So you're talking about a much bigger than 50% drop. You've looked at a company called Burner, which I don't think I've ever actually talked about. It's basically self-defense. They're things that look like guns, but don't shoot bullets. They shoot, basically pellets that are extremely painful, some of which you can buy pellets with tear gas, basically incapacitate people without killing them. And they're growing at 70% year on year. And they sold off from, the 30s down to $15, basically. So again, a fast growing company just reported 70% growth, rolling out stores, huge growth ahead of them, and, down 50%.
Are they
So
used directly by consumers or are they for businesses?
yeah, I think you can even buy them in Australia because they're not technically a weapon, and get them shipped here. But they're for self-defense. They look like pistols. By all accounts, extremely effective. And if you want to buy something but you don't actually want a gun and you don't actually want to shoot somebody and kill somebody if a situation escalates, then it's basically a consumer market for that. It's one of those companies that's right at the beginning of their growth curve. Like clear product market fit, growing extremely fast. People really love them. They get ongoing revenues from the pellets, and it's a really exciting opportunity. And again, without this sell-off, these things would have, that's gone from maybe you can make 15 to 20% a year to all of a sudden, that could easily be a 2 or 3x in the near to mid-term. And that's just saying it gets back to where it was when it was a much smaller company. So there's some pretty interesting companies that we're looking at. Another one is, which I know you've been doing a bit of work on, is Reddit, which is also growing extremely fast. And I think that's dropped over 50% now as well.
I have been looking at Reddit. They're up to 97 million daily active users, and the majority of their revenue comes from ads, which they've been expanding. They ended up with 1.3 billion from ad revenue alone for the full year. And it's interesting to see what will come on May 1st when they release Q1 of 2025.
Yeah, I mean, it's a great company, right? It's got a lot of data. So all the AI companies are looking for data. I'm not sure it's quite as good as having access to every tweet, which XAI has, every video that Google has with YouTube. Actually, I'm not entirely sure how much of our Word docs, Microsoft actually reads, but if they wanted to, they could probably use that. But they definitely have like some unique content. It's still interesting. It'll still be interesting to see how it goes in terms of some of these companies trying to monetize it. Because if the Chinese are basically just going to rip it off, and there's already open weight models that have access to, the existing internet up till today anyway, I guess there's only so much they can really charge.
I do think that Reddit does have something special in the sense of the online communities, and I know that those have been ingrained for a number of years, and they have a community thread for absolutely everything. One of the most recent moves in the last 2 years has been their international and the AI language converting. So there are so many different groups, subgroups, and special interest groups that are all now used in different languages as well. So I think it's a really interesting space to watch.
Yeah, definitely. I mean, I guess the big risk for them is they are at the mercy of Google. So you probably notice if you search something in Google now, they show Reddit results. That could be switched on or off depending on, Google's strategy at any given time. And their decision to promote Reddit has a big impact on their results. But yeah, you look at their numbers, it's pretty wild. Daily active users up 39%, revenue up 70% plus. Definitely one of those fast growing companies. But again, look at the moves in the last few weeks, 57%. So that's a huge move. And that's a move from February. That's not a move of 6 months. So, that's the part of our portfolio that's basically been sitting in cash. And now we can just wait until we get a buy signal. And, there's a good chance that happens quite soon. We're talking about tariffs and risk. The other thing I didn't mention was that everything's extremely oversold. So all the algos flip from max long in February to max short, or very close to max short. There's obviously a huge amount of uncertainty. A lot of funds have raised a huge amount of cash, including ourselves, that will be deployed. And so it's worth keeping that in mind because often what happens, there's always something different that sends markets into a tailspin, but invariably they do recover and everybody who sold buys back. So there's a huge amount of buying behind every stock when things do kind of settle. And, the other thing is that short sellers have been a huge part of the market at the moment. So Reddit short interest, 17%. Pretty much every US growth stock we look at has huge short interest. I noticed Transmedics, which is something we sold a while ago, that started to rise again. And that is one of those incredibly heavily shorted stocks. I think 5 years ago, I was probably pretty blasé about going against short sellers because in a lot of these companies, there's times when everybody pulls back from the market. And if you've got a seller selling, a short seller with effectively unlimited capacity, selling into that kind of market, you can get huge moves. The obvious one was Carvana, which went down, 99%. But then when it did start rising, the short sellers had to buy back at higher and higher levels to the point where they could actually, get the raises away that they needed to do. And the founders even ended up selling into the last of the short sellers that threw in the towel. So it kind of added insult to injury to the money they lost, that it was actually the founders cashing out. But yeah, Transmedics, 29% short interest. In Australia, we've been invested in Clarity. We sold a fair bit at 8 and another chunk at 460. And then that was pretty close to where it was trading at the beginning of the year. It dropped to 3, which was painful. And then when Biotech went to complete tailspin, it halved again from 3 to $1.50. So huge moves. We weren't in Opthea, but feels like we may as well have been. That kind of nearly $9 to $1.50 is an enormous move. But that's basically been driven by short sellers. On some days, they're over 50% of the trading volume. And the reason for that is obviously that they're preparing for a raise. Clarity is some time away from revenues and certainly profits, and we'll need to raise capital of some sort. And so the smart move is to sell short ahead of that and then fill that in the raise. I'm not sure how smart it is to short down here though, because here you've got a much smaller company and, it just went from 3 to $1.50 in a few weeks. You could blink and it's back to $3. And, we spent a lot of time on this company over the last few weeks. We spoke to Professor Louise Emmett, who's running the head-to-head trials with Clarity versus an agent. It's not Telix's agent, but a similar agent. And we recorded a podcast with the CEO. And basically there's an impression that the data hasn't been as good. They came out and then basically cured somebody and the market got extremely excited about that. But really the data has been exceptional. They released data in March, which puts them at market leading in therapeutics. And these things do have value. So at times like this, nobody really wants anything that's kind of 2 or 3 years out. A play that's going to develop over 2 to 3 years. Everyone's extremely short-term focus during these market sell-offs, but it's created an enormous opportunity. And this isn't a kind of Opthea where we don't know if it works. We have a very large body of evidence in a number of different trials on its effectiveness. So it's really exciting. But, again, the short selling is making a huge impact. But I don't actually really worry too much about, again, obviously it's caused a huge drop, but you got to remember the short sellers have to buy back. So you can buy stock and, if people hold it long term, they can effectively hold it, definitely into the future. But short sellers do have an expiry date. It's very hard for them to hold short positions for a long time. And if stocks start rising, they have to buy them back. You can't lose 200 or 300% on a stock. In a way, it's almost like spreading over that cap raise over extended period of time. So the whole market at the moment in that company, there's a huge amount of buying power behind it, and it's going to come from the people that have sold it down to these levels.
Absolutely. And do you see more of Clarity's results coming out and making bigger market moves? Do you see that taking 2 to 3 years, or do you think that's something that they could achieve in the next 12 months?
Yeah, it's hard. At the peak, you could justify the value by looking out many years. Now you could justify, the short case is, look, it's got 12 months of cash or early mid next year. It's multiple years out from significant revenues. It kind of depends how you look at it. You could justify both cases, but there's a huge amount of data coming. So there's a head-to-head trial that will read out this year. There's 2 phase 3s. We're getting steady updates from their cohort analysis, all of which is actually ahead of Pluvicto. Pluvicto's market just expanded to 9 or 10 billion US. So Pluvicto is the radiopharmaceutical treatment marketed by Novartis in the market. It's already in the market. I think in the first year they did about $1 billion of revenue, and they're expecting that to expand many, many times. And they just got moved to an earlier stage setting, which is 3 times the size of the latter stage setting. So remember, these things all start, basically with patients that are right at the end of their journey, that are willing to take the risks of an experimental trial. And then as time goes by, and new treatments prove their effectiveness, they get moved further and further up the treatment pipeline if they're better and if they're safer and better tolerated, of course. And Pluvicto's moved to early stage, and Clarity's changed their trial design to include patients at an earlier stage. And we know from their data release, in their data, so far they're ahead of Pluvicto with 1 dose. Now, obviously it's a much smaller trial. There's all the usual caveats that apply in biotech, but that's pretty compelling because, you've got something that's potentially better than a drug that, a radiopharmaceutical product that will sell in the billions over the next few years. And then you compare that with the current, 500-600 million market cap, and that's how you can justify 10 or 20x return in the next 6 months, but potentially in the next few years. So that's quite exciting. We had that interview with the CEO, Dr. Alan Taylor, and he mentioned that Telix reached out to him, and I got the impression that was kind of deliberate, like it was said intentionally. Obviously, there's only so much you can really do with statements like that. And, this is public forum. The things that we really want to know, the CEOs aren't really allowed to tell us. But I thought that was kind of overlooked and interesting. Well, those companies are competitors. It seems like, I don't think I'm treading anyone's toes, but it seems like there's like particular competitiveness between the CEOs of those companies. I think most Australian biotech investors probably own both. Telix has been huge, like it's changed the lives of some investors. It was trading well below $1, and is now in the mid-20s. So that's a huge return on the right side of that. And it was mostly Australian investors, as far as I know. So you're talking about like $10 billion like sitting on the balance sheet of Australian investors. But, Clarity does have a point. They might have a superior diagnostic. And if it's not Clarity, somebody else might. The diagnostic is not as good as it needs to be. Like ideally, you'd have a diagnostic that was like above 90% in terms of sensitivity. So you knew if you had metastatic disease, you knew if you had to go through radical treatment. It's not that good. There's a lot of people slipping through the cracks. So whether it's Clarity or somebody else, Telix at some point will probably have to respond to that. And I think most Australian investors would prefer those companies were collaborated a bit more. And you had, the immense revenues and execution of Telix and the funding, combined with like one of the most exciting next generation assets as well. But it's the good news is the data is good. Like all of our biotechs, they got smashed in the last few weeks, but the data is good. They do work. So as time goes by, they'll just continue to prove that in our view. The return opportunity is just vastly bigger than it was before.
Do you believe the sector is being mispriced if the data has been good and overall in the longer term they look like they will be positive, but right now they've taken such a hit in the last couple of weeks?
Yeah, I think mispriced is hard because mispriced, like I said earlier, you can price it however you want. You can heavily discount anything in the future. You could put a huge risk weighting in, and you could argue that's justified, and you'd be right. You could say, well, it's not just them. Remember, there's multiple companies in the space. It's not a two-horse race. You don't just have to compete against the existing standard of care. You have to compete against anything else that comes out in the next 2 or 3 years. Or you could say, actually, it is market leader. We spoke to Professor Louise Emmett, who was pretty clear that, if the data is better, she's going to switch her whole practice. That's the feedback that, we've got from other key opinion leaders. They will make the switch. They already have made the switch when they move to Telix and Lantheus. There's actually still a long way of that move to go. There's still a huge opportunity for those companies. And so if you take that view and you go, okay, well, if we think they can take a meaningful share of a multi-billion, potentially $10 billion market, then, it's materially undervalued at a few $100 million when they could be doing billions of revenues within 5 years. It really depends how you look at it, but it does very much change the risk reward. We've actually basically bought back in the last few days almost all the shares that we sold at $8 and $4.60. We basically reset the entire position. And so I guess we'll wait.
How do interest rates play to all of this?
It seems like US rates are quite high. They're the usual kind of doublespeak from the Fed. They didn't cut rates, but we can see the inflation is falling. I think they're scared that this tariff move is actually going to increase inflation. Tariffs are usually inflationary. You're increasing the price of cheap goods. And no, even if you do stimulate domestic production, that equilibrium's going to be higher than if you just allow the cheapest producer in the world to make the good. And obviously, if you think about what happens to GDP, there's no doubt on a nation, there's an argument to be made that a nation can protect its own industries and there's benefits to that. But there's no doubt on a global basis, you definitely want products produced in the cheapest, most efficient place. That is like without a doubt. So adding tariffs and trade barriers is bad on a global sense. I think the Fed's probably worried that it's going to be inflationary, that this is a big price increase on a huge amount of goods, huge amount of input goods to the United States. And even though that hasn't come through yet, well, the tariffs haven't come through yet. The impact of that hasn't been felt. So they want to keep rates high and really make sure inflation doesn't get out of the bag. But without that, there's no doubt there would be in a rate cutting cycle as we are in Australia. And I guess they've already started cutting rates in the United States just a little bit. You can see the path out. It's unclear how bad the hit to GDP will be. It's unclear that, if things actually get bad, that the US and Trump in particular decides to walk things back. He doesn't want to see markets in free fall. He doesn't want to see GDP collapse and there to be like a devastating recession. But, if you combine the fact that market positioning is so one-sided at the moment and you have a huge amount to drop on interest rates if things do get bad, or even if they don't get bad, if the inflationary effect of tariffs doesn't come through, either because tariffs don't come through or for whatever other reason, demand is weak, that's a pretty good recipe. So I don't know when that comes into play, whether it's soon or whether it's kind of later in the year or even early next year. But at some point, I imagine you have this combination of huge amount of buying power plus falling interest rates, much cheaper stocks, which is generally a pretty good recipe. And it's kind of exciting. And again, we're still sitting on a lot of cash. Did a bit of buying this week, which is the first time we kind of stepped back into the market in a significant way. We still have a lot of cash. We still have a lot of, and we went through a couple of them, but there's a number of growth stocks that are down 50, 60, 70% now, that make for really good buying. The moves on the backside of these kinds of sell-offs can be substantial, particularly if things push to new highs. The playbook for us now is we are still extremely confident in the trial results of the biotechs we're invested in. Those companies could double or triple quite quickly, which would basically just take them back to where they were a few weeks ago. There's been no data release or update that's driven them down. This is one of those times that it actually is purely market moves. So you get a huge lift to the portfolio there. But then ultimately, if we deploy correctly the huge amount of cash we have now, then you have a chance to kind of string together both parts of the portfolio that can fire at once. So that's really what we're playing for. So now we're looking at companies like Reddit, we're looking at those growth companies, and it's kind of exciting. It's obviously it'll be much more fun when markets start grinding up again, particularly if they grind up slowly a little bit every day, which is obviously much easier to kind of handle.
When things hopefully start to go back up, are you going to focus primarily sector-wise? Is that what you're going to be looking at? Or are you going to be looking at metrics strictly to do with growth?
Yeah, I think we've got enough. Put it this way, I think we've got enough biotech at the moment. It would take a lot to have a new opportunity. It'd have to be really compelling. And actually, we're going to be launching this new fund. That's weeks away now. It's amazing how long these things take. But that will be purely growth. Won't have biotech. It'll just be kind of billion-dollar companies and larger. And yeah, I think those are. There's a lot less. There's no Optheas in that basket. These aren't companies that can vanish overnight. They have latent value. They have users, revenues, in most cases profits. It's a much less volatile part of the portfolio, and it works extremely well on risk models as well. So that's quite exciting. And I think now is a really good opportunity for a growth investor, because a lot of this stuff started selling off from July last year. Semis have been selling off. It's April now. Soon it'll be a year where those companies have sold off. They're extremely cheap now. There's very bad outcomes are priced in, but you still have that tailwind of, every year the demand for compute going up significantly. And then around then, obviously, all these other growth stocks started selling off and have really been in this sell-off for 9 months now, and have trading now. So the combination of those means there's a huge amount of opportunity. And it's a pretty exciting time.
Yeah, that sounds really exciting in the next couple of weeks or months. Definitely something to look out for.
Why don't we wrap up there?
Sounds good. Thank you so much for having me.
Thanks, Ellianna.